As economic growth slows and uncertainty remains in global markets, Singapore banks say investing in gold would be a good way to diversify and reduce overall risk. All three local banks have published differing reports on their recommendations to investors. Gwyneth Teo explains.
With central banks continuing to slash interest rates, yields on bonds have reached near zero or even negative in some markets. DBS Bank is advising its clients to be selective and focus on those that generate income. For instance, lower-rated bonds in the BB and BBB space currently offer the best value, as well as dividend-yielding stocks such as Singapore REITs. But the bank is putting relatively more focus on equities, especially in sectors that will remain agnostic to a global economic downturn.
The world will not stop being an e-commerce or a digital economy just because of a downturn. Neither do, the population of the world becoming younger. It's aging. It is aging. So there are, expressions to capture this theme of an aging population.
United Overseas Bank says falling interest rates could indicate weak economic fundamentals, where companies are earning less. This would mean lower returns on equities. Instead, the bank advises being more selective with which bonds to invest in.
Especially in the case whereby interest rates, if they are moving lower, the interest rate risk is not there. So you can, in the past, maybe you are looking at a 2-year bond. Now maybe you can look at a longer duration bond, or even going up the credit curve. That means lending, purchasing bonds that's issued by corporates. That will give you higher returns.
Overseas Chinese Banking Corporation has advised to stay invested, be it in equities or bonds. It says investors should hold on to more cash so they can catch hold of good buys when valuations change due to the volatility of the market.
You want to make sure that, if there are sharp pullbacks, you at least have some dry powder they can apply to the markets on sharp pullbacks. So it's not a good idea to throw all your funds into the market at this juncture. If you've got spare funds looking to invest in the markets, I think it's best to spread out investments, dollar cost average over the next 12-18 months, because one thing we can be sure about is markets are going to be fairly volatile given the backdrop of global uncertainties.
Even as all three local banks expect growth to continue slowing over the next year, they don't expect a global recession to take place.